Shares of SoFi have jumped recently, and the reason is behind a ruling or a lack of ruling at the Supreme Court in relation to student loans. This is going back to the Biden administration trying to forgive student loans for borrowers who are either low income or who are paying over a certain percentage of their income as student loan debt. But the Supreme Court has upheld a lower court's ruling that that's unconstitutional. Basically, that the administration can't spend money without congressional authorization. So I'm not going to get into the legal ruling, but I do want to get into the impact that this has on SoFi because it's a pretty big number for the company. When you look at the lending portfolio that SoFi has, there are three big segments. There's student loans, there's personal loans, and there's home loans, which is actually a relatively small business for SoFi. So I want to get into why this is actually so important for SoFi and the future of the company. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get to what we learned last week. This is from CBS News. And what they say is the Supreme Court on Wednesday declined to reinstate a program called the Saving on a Valuable Education Plan that an appeals court is currently hearing. The plan would have erased up to $20,000 worth of student debt per borrower and lowered loan payments to as low as zero for some low-income borrowers. So there's two pieces to that, the loan forgiveness piece, and then also lowering the payment that some borrowers would have to make. So basically this goes back to the 8th Circuit Court, and basically the Biden administration is going to have to continue to argue that case in court. This is again another one of these cases that could change depending on the election in November. So why is this so important for SoFi? If you go to SoFi's financial segments and where they make their money, there's three segments in the lending segment. This is student loans, personal loans, and home loan originations. If you go to Q2 2024, you can see here that the biggest segment is personal loans. So that's where there has been a ton of growth for SoFi. It's kind of what the company identifies as. And I have called this the Trojan horse into the banking industry for SoFi. This is a business that not a lot of people want to get into, not a lot of banks want to get into. So SoFi has said, hey, we'll do that. We'll take on that risk. We're going to be able to build a platform where we're going to know more about people's ability to pay back their loans. We're going to be able to take appropriate risks. So that's the idea behind that. Same thing behind student loans, but student loan origination for the business has actually kind of declined over time. You can see if you go back to Q1 2021, $1 billion in student loan originations, that has gone down to $736.5 million. A number of reasons behind that. There was the pandemic impact. There's the ability to originate student loans in all kinds of different places, especially through the government. But this was a pretty big business for the company. So why is this a big deal financially? Well, look at the fair value of student loans that are on the balance sheet. That was the numbers that I just gave was the originations on a quarterly basis. So that's not the value of those student loans. The value has actually increased from a principal perspective from $2.6 billion to $6.9 billion on the balance sheet in the most recent quarter. But this is where the banking part comes into this. If you pay back a loan earlier, the value of the loan is lower for the originator. So right now you have $6.9 billion worth of unpaid principal, but the value that the company has on the balance sheet is actually $7.2 billion. So nearly $300 million of accumulated value in what they call fair value adjustments to the value of those loans. So what is the fair value adjustment? Fair value adjustment is something like a bank gives you a loan for 10 years at 5% interest, and then interest rates fall to 4%. Well, the value of that loan is now higher because current interest rates, current borrowing rates are lower. So that loan is going to be more attractive to somebody who is trying to buy that loan. So that's what these fair value adjustments are. But in theory, at least some of these gains that SoFi has had would evaporate if some of these loans were forgiven or paid off early. And also the business itself may get smaller if the student loan business isn't as attractive for originators like SoFi. So that's the idea behind the market's reaction. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So is this actually something to worry about with SoFi? Well, here's a look at the company's segments and the revenue behind them. You can see that The teal segment is the lending segment. So this is actually the biggest segment for SoFi. So something to definitely keep an eye on. If you look at the contribution profit of each of these segments, again, the lending business is the most important for SoFi right now. But look at the trends. Look at the trends of the technology platform, which is in blue, and then also the financial services business that is in orange. Those are really where the company's growth is coming from. Technology services, technology platform revenue CAGR is 48%. And you can see that that is contribution profit going back to 2020. And if you look at financial services, that compound annual growth rate is over 200%. Now that's from a very, very small base in 2020. If you just take the numbers from 2021, that CAGR goes down to 152%, but still phenomenal growth in financial services. And that's as the lending business is kind of flattening out. What's far more important for SoFi is the fact that interest rates are slowly starting to come down, and the Federal Reserve has said that they're probably going to cut rates as early as September, potentially 25 basis points, maybe even a 50 basis point cut in September. That's because the economy is weakening a little bit, but SoFi's management has really pulled back on their lending business in part because they were anticipating fewer rate cuts in 2024 than a lot of their competitors. So they didn't want to get aggressive in cutting those rates. And what management explicitly said is, hey, if the Federal Reserve cuts rates a whole bunch of times, 6 rate cuts is what was expected earlier this year, that means that the economy is terrible, that people are going to be not paying back their student and personal loans. So that's why they have taken a little bit less risk in those businesses in the last few quarters. But now as rates come down and the economy seems to be doing relatively well, maybe have some sort of soft landing, don't be surprised if those lending numbers start to tick up just a little bit for SoFi. Management has said that there is plenty of demand for their loan products, just not something that they're diving into right now because they don't like the risk reward profile of lending in the current environment. But that could change as rates start to come down. So for SoFi, the student loan business is still a really big business. And the reason that there was such a reaction from the market is the market wants to see the profits that the company has either already booked or potentially has in that business, that actually still remains. But when you think about SoFi as an investment, if the student loan business gets smaller and we start just relying on the technology platform and financial services in the future, I don't think that's necessarily a bad thing. It's probably a better risk reward profile. And it's definitely a more leverageable business to grow in those two segments than it is to grow in something like student loan financing. So not something that I think is all that big a deal for SoFi, but it does make sense that there was a market reaction on the positive side because these student loans aren't going to be paid off early. So something to keep an eye on. This case is definitely not over, but we know that it's not going to the Supreme Court at this point, and it's very possible in the next year or so that the case just kind of fizzles out and these student loans are not forgiven. Where things stand today, that would be a positive for SoFi's financials. So that's why the stock reacted the way that it is. But let me know what you think about SoFi and the student loan business. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.